question is, you are evaluating a 4-year project with an initial investment of 10 million on 1st January 2023 and the following cash flows. Of course, they have the following cash flows characteristics. We have debt, which have been given. We have values, which have also been given. And we have the rates of 8%, which has been given. Now, the discounting rate has been given as 8%, as you can see on our question there. Now, required. Calculate NPV and XNPV of the project and determine whether the project is viable. We'll be determining whether the project is viable. Number 2, highlight the causes of difference between NPV and XNPV. Explain which one you would use in your analysis and why. Then again, calculate IRR and XIRR of the project and determine whether the project is viable. Highlight the causes of difference between IRR and XIRR. Explain which one you will use in your analysis and why. So this is a very, very nice question for NPV concept and also IRR concept. Now, for NPV, the net present value, of course, as we said earlier, NPV is the present value of inflows minus the present value of outflows. In Excel, we use the NPV function. So you just say equal sign, then NPV, tab. Tab means you double click, then rate. You click on the rate. I hope we have the rate up there. The rate is 8%. So click on the 8% in cell D12. No need of locking because you're not dragging any formula, so don't lock anything. Comma. The values, you can see the values. I want us to select all the values. You just select like a range, but select from the inflow. Now the inflow starts from 30th June. The first one is in bracket because it's an outflow. So just pick from 2750 to the other 2750. Don't select the dates because NPV doesn't look at the dates. It assumes exact timing of 1 year time frame between each cash flow. So pick from 2750 to 2750 as a range. Yeah. Then once you've selected that, you close those brackets. Close those brackets. Remember, we've selected our elements up there. Then add. Since the outflow has been presented as a negative, you add. Add will simply means that you'll be offsetting the difference between the two. So you add the outflow. So close bracket and then add the outflow up there of 10 million. That way. Add the outflow of 10 million and the formula is there. So the outflow is in cell D6, enter, and that is your answer. NPV is 791 to 73.161. Is the project viable based on NPV? Definitely. Yes. According to the decision criteria, if NPV is positive, you take the project, so it's viable. If NPV is 0, you become indifferent because it can either be rejected or taken. If NPV is negative, then you reject the project. So in this case, the NPV is 791, therefore we accept the project. What about XNPV? Equal sign. Then XNPV, remember the difference between the two. NPV doesn't take into account the exact date that the cash flows occurred, but XNPV takes into account the exact date that these cash flows occurred. Now you can see up here that we have date and values. So date, the outflow occurred on 1st January. You started receiving money on 30th June, the other one on 31st July 2024, 30th September 2025, and 31st December 2026. That's how you receive the monies from your project. Now for XNPV, you start with the equal sign XNPV, then rate. So rate is the 8%. that is D12, comma, we want to go for the values, and you select the values from the outflow itself. So don't leave the outflow. We are selecting from the outflow all the way to the last cash inflow on 31st December 2026. That is the 2750, that way. Then you can see where the formula is taking us. There's a syntax here, comma. Then now pick the dates. You can see it's telling you that now pick the dates. Pick the dates. From the first date of 1st January 2023 to the last date of 31st December 2026. That way. Then you can close the bracket, and that becomes your XNPV, 1,062,559.853. Now investors prefer XNPV compared to NPV because of what we've said on exact timing, the exact dates that the cash flows occurred. But still, they're both positive, so we'll still go for the project. It's viable. Lastly, IRR and XIRR, still another simple formula. So equal sign, IRR, tab. Now for IRR, you simply pick the values. So equal sign IRR and pick the values from the outflow moving down. Simply pick your values from the outflow moving down. Remember, IRR is internal rate of return. That is a rate of return that gives you 0 NPV. A rate of return that gives you 0 NPV. So that means that you will take the values from the outflow all the way to the inflow. That way. From the outflow to the inflow. From the outflow, then close bracket, that is all, and enter. You don't use the rate when doing IRR. So from D6, which is this, to D10, which is what we have here. Now it is 11.541 as our answer. XIRR, that will be equal sign, XIRR, then values and then date. Just go for values and then date. So values are here, comma. So once you have the values, you do a comma. Then you go for the dates. Yeah, all the values, then all the dates. Comma, then all the dates. Close bracket and enter. That is XIRR 13.583. 13.583. That way. So that's how you get NPV. That's how you get XNPV, IRR, and also XIRR in Excel. Of course, we said that investors prefer both XNPV and XIRR because they take into account the exact date that the cash flows occurred, as opposed to NPV and IRR, which assume that the individual cash flows always occur at a regular interval of 1 year. So investors would rather go for the XNPV and XIRR.